Right, so welcome to my friends that are watching this live on YouTube. Yes, I need you to subscribe, to like the training, and to share with someone. In case I'm sharing certain things along the way and you don't see clearly, you may want to zoom in the screen so that you get the whole picture. Okay, so I think we are ready to get into our discussion this evening. Now, can I know how many people I have here? We are 11 of us who are in the Zoom call. How have you been, everybody? Just say hi to me. Can I know if you are there and you are live? You can hear me clearly. Uh, uh, are you alive? Are you alive? Are you alive? Are you alive? Let me know if you are alive. Is my sound very clear? All right. So I was saying that the futures trading is going to be a, a full course. I'll be moving slowly with you, right? I'm still a student of this whole thing, but I'm going to be sharing with you what I've learned, what I've practiced, what are my experiences. So where did this all start from? Let's start from there, right? So I think it's now 2 weeks. Um, when uh, when I started hearing the move of the 1%. So let me just quickly write here the name of the strategy that we are using. The name of the strategy we are introducing basically is the 1% 100 strategy, all right? 1% 100 strategy, or 100 times. And this strategy is basically targeting at trading in the futures market when you are collecting 1% profit of your capital 100 times. Now, if you've been trading in the spot market, 1% of $100, I mean 1% in the futures market is 10%, okay, because of the leverage. We are going to be able to break this down. So futures market is a great opportunity for you to maximize on profit even when you have small capital, right? So a few days ago, V6 Julius calls me and he tells me, Ashraf, this is how he asked me, Ashraf, are you a risk taker? Are you a risk taker? Then I said, yes, I am a risk taker. And he said, do you have spare $50? $50 to spare? And I said, yes, it's available. I can do that. Okay. And then he said, I'm going to show you something. I'm going to show you something. So we didn't get a chance to get on the call. He wanted to show it to me. But then there was a bit of challenge. I think he was very tired and he said, okay, we'll meet later. And then later, I connected on a call with a few leaders that he was explaining. He gave me a private link and he was telling us the power of the futures market. And after that call, I decided to try futures with $20, just $20. And this was yesterday. I tried this $20, and guys, no, that was the day before yesterday. On which day? That was on 16. So I got in the trade with $20 and I made close to $4. Yeah, it was $4. $4. Wow. Now, that was mind-blowing. $20 within a short period of time, within less than 10 hours, I won a few trades. I think there were 2 trades, not 3. And man, I had made $4. Now I increased my risk appetite. I took it to $50 and then later I upgraded it to 20 to $100. By the time I was retiring the day yesterday, I had made $33 with $100. By the time I was closing the day yesterday, I had made $33 with $100. And today I've made $12 with same. Now, something happened. I'm going to break the things down. You know, I told you I like experiencing things before I share with you. For my friends that are new in the business, I would advise that you explore the spot market, utilize the tutorials that are available together with the sessions that keeps going on how to trade in the spot market. And I think it is what is going to set our pace uh, of our call tonight. Understanding the difference of the spot market, the futures market, and then we shall dive into setting up your futures account, okay, and doing the API binding. I did it yesterday, and the videos are already available, so I may not take too much time on that. And then we are going to go ahead and look at a few other things that we can learn about the futures trade. How do you set up a trade in the futures market, okay, successfully? But first of all, let me know, do I have some risk takers in the call? How many of us you consider yourself a risk taker? Hmm? How many of us you consider yourself a risk taker? Guys, I'm having a bit of flu. That's why, in case my voice is not coming out, I'm having a bit of flu. I'm having a bit of flu. I'm having a bit of flu. So let us start with putting a clear difference between the two markets. And if you are aiming at diving any of these, I mean, putting our feet into the futures market, we should know what is in for us and how to navigate through it. All right? How to navigate through it safely and profitably. Safely and profitably. All right? Just give me a second. Just a second. Eh? Okay. Can you see my screen visibly, clearly? Is my screen clear? All right, so let's get kick-started with, first of all, understanding futures. We are diving into a market called futures. So if you are just starting out your journey, in the crypto market, we have two types of markets. All right, let's get this started. Right. So we have two types of markets in the crypto. Come on, come on, come on, come on, come on. We have the futures market and the spot market. Okay. The futures market and the spot market, or the spot, and then we have futures on this side. Okay. They are both great markets if you understand how to navigate through them. And this is what we want to focus on. So what we are going to, first of all, understand, since majority of us know spot market, how many of us, at least now, you have some knowledge on the spot market? You can successfully buy a coin in the spot market. Give me a 1 in the chat. How many of us you can successfully buy a coin or carry out a trade in the spot market? Give me a 1 in the chat. How many of us you have an experience right now? You can successfully buy a coin and sell it and make a profit in the spot market. Can I get some yeses in the chat? My master says yes. I see Atesta says yes. I see Colin says yes. All right. So I think if you don't know, spot market is a market whereby when traders pay, okay? Goodness. Just a moment. All right. Sorry guys about that. Sorry. All right, so in the spot market, this is where when a trader buys a crypto, you own it. You own a crypto. You own the crypto. So if, for example, you bought Bitcoin of maybe $100, okay? $100 worth of Bitcoin, you will have the Bitcoin. You have it, okay? You can even remove it from wherever you bought it on an exchanger, okay? And you keep it from somewhere else. There are different ways to store our crypto. We can store them on hardware wallets, all right? So in the futures market, here, you own the crypto. And also, I mean in the spot market. Still in the spot market, if it is in terms of, you know, security, it is more safer here. Low risk, all right? Low risk. Low risk. Because even if the price of the coin went down, you basically still have your assets. You have your Bitcoin. You have your crypto. all right? Whether the value has gone down. If you bought this one Bitcoin worth of $100 when the price was at maybe each BTC was trading at a price of 100,000. Okay, even if the price went down to 80 to 50,000, the value of your Bitcoin has gone down, but you still have your Bitcoins. So you don't have to panic. If the price bounce back, you will be able to profit. All right. So basically, this is the spot market. You can buy from here, the price go down, and you are still okay. Right. And if the market go up, it goes beyond your entry point, your entry price, you are going to be able to profit. That is the spot market. Right. The other thing about the spot market is you profit one way. It's a one-way market. It's a one-way market. When I say one way, I basically mean you only buy low and sell high. You buy low and sell high, right? When the price is low of the coin, you enter here, it goes up, you make a profit. If it comes down, you enter here, it goes up, you make a profit. Basically, this is the spot market. We buy low, we sell high. We buy low, we sell high. Are you with me now? Are you with me now? We sell high. That is, again, spot market. That is spot market. Still, in the spot market, you only use, there is no leverage. Okay, let me just introduce the term leverage here as I explain the differences. There is no leverage. What I mean with this is the money you are using is basically the actual amount of money you are using to own or to do the trading. All right. So if you are having $100, you make profit off your actual amount of money or your actual trade, your actual capital. So if it is $100, it's $100. All right. That is about the spot market. I think the simple difference. Now let's get into the futures market. Let me also note that this market is suitable for beginners. Suitable for beginners. So to all the leaders here, don't start your new person who just joined the team in the futures market. All right? And if you were a new person in the business and you feel you've joined in a time when we are talking about the 1%, 100 times strategy, and you feel like jumping into the futures, don't rush. All right? You still have all the time. This is what I keep telling people. From the time you trade, you buy your robot, to the time of expiry, you have 12 months. Majority of us, we want to make the profit of 12 months in our first week. Week one, you want to make profit of 12 weeks, 12 months. Within 1 hour knowledge. 1 hour knowledge. You want to make 12 months profit. And you are within 1 week. So cool yourself down. Crypto is profitable, but it can also be very, very risky if you are not, if you don't know what you are doing. If you don't know what you are doing, all right? Let me also discuss the worst case scenario of the spot market. The worst case scenario of the spot market. What is the worst thing that can happen to a trader trading in the spot market? The worst case scenario is when the coin is called floating loss. Let me state it properly. Abnormal floating loss. Abnormal floating loss. This is the worst case scenario for a trader who is trading in the spot market. yes, you are owning your assets, but if you intended to buy the coin to get in a trade for maybe just a few hours or maybe just a few days, and that trade happens to go against you. Remember, we said that this market is a one-way market. You buy low and sell high. You buy low and sell high. Are we together now? This is how the spot market behaves. So if you bought low and the market, instead of going up, it went against you, it went low, all right? You bought here, it went down, or you bought here and it went against you. When the trade goes against you in the spot market, you have not lost your money because you still have the coins, you still have the assets, which if you are patient enough and wait for some time, if the market bounces back, if you traded the proper project, it can bring back your money. Now, the worst case scenario is when the waiting becomes abnormal. If you expected it to be in a trade for one day and it goes to weeks or to months, that is when people lose patience. And the process of losing patience, because this asset has reduced in value. If you had invested $100 in that particular coin, and yes, you have that coin, one coin, you got one coin at $100. The coin is still with you. You can keep it. But then the value of that coin has plunged to 50%, negative 50%, meaning the coin that was worth $100 on the market at the time of purchase, it is right now at $50. So if you choose to sell that coin, you are going to make a loss of $50. You don't make a loss until you choose to sell the coin. That's why we don't call it a loss. We call it a floating loss. Give me a 1 if that is clear. That's why we don't call it a real loss, because it doesn't happen. Your money is still in the coin. Only if you sold the coin, you are not in a loss. For as long as you are still having the coin, you are not in a loss. Is that clear? Please give me a yes if you are here with me. As long as I am still with my coins, even if it takes me 10 years, I am not in a loss. I am floating in a loss. So if the market changes, my value, the value of my coin, and it grows, I can make a profit. So one of the biggest trading skill you have to have in the spot market is patience. One of the biggest. Patience. Because when you lose the patience in the spot market, you lose the battle. When you lose the patience, you lose the battle. As you get to learn more the psychology of the market, how big traders, how big investors, how big institutions are going to manipulate the market, tempting you to sell your coins at a loss, you will be able to gain stamina and strength. However, one thing we love about the spot market is the security and peace of mind it will give you. Hello? So we can put here disadvantages of this market is that there is small money, small profit. Small profits, small profits. And sometimes you can get stuck in a coin. You can get stuck in a trade for months, and it holds your capital. It holds your capital for months. How many of us, you have traded a coin, you wanted to move out of it in a few hours, and it went to weeks? Can you give me some yeses? And you are there. You have pressure, especially if you don't have enough capital. Now, look, friends. Look, friends. Look, friends. Let us now look at the futures market. Let us look at the futures market. Friends, here in the futures market is basically contracts. Altogether, it's basically contracts. You open a contract with the futures platform. In this case, we are going to use the scenario of Binance or an exchanger that you are trading on. I wrote here in my notes, futures trading is trading the price of the cryptocurrency without owning the crypto. Altogether, futures trading is trading. This is in my notes. You can do that. You can also do your notes. I told you this is going to be more like a class, a course. We'll be able to move bit by bit until you understand this. Okay? Futures trading is trading the price of the crypto, trading the price of Bitcoin, of Ethereum, whatever coin that you are going to choose to trade, without owning that coin. So we are just positioning ourselves with our analysis. We don't have to own Bitcoin to make money from Bitcoin. With little money, we can position ourselves and be able to make profit either if the market goes up or goes down. So you don't have to own the Bitcoin. You don't have to own the crypto. So when the market goes down, if you position yourself and you think the market will go up, in this, we are calling this longing the market. Longing the market. So you are opening up a contract with the exchanger and you are telling it that based with from your analysis, you have confidence that this price, remember we are trading the price. We are not trading Bitcoin itself. We are trading its price. Give me a yes if you understand what I mean. So if Bitcoin is at $100, $100,000, okay? One Bitcoin is $100,000. In the spot market, if you put $100,000, you are going to be given this one Bitcoin. However, in the futures, you are just trading the price of Bitcoin, the movement based on your analysis. That if the price go down, you are opening a contract with the exchanger. If the price go up, if you are seeing potential of the price going up, you are going to long the market. We call it longing the market. If you are seeing the price of Bitcoin going down or any other, please don't zoom, don't zoom, don't zoom. See what you are doing to us? You are now totally messing with our notes. Don't zoom. Now, in the spot market, in the futures market, I said we are trading the price of the project or the coin, the market direction. If it goes down, we are shorting the market or we are shorting the trade. So this is it. Upward is long, downward is short. Give me a yes if that is clear. Give me a yes if that is clear. Now, what are the advantages? After understanding what futures is that we don't trade the coin, we trade the price of the coin. Now, let's look at the advantages of futures market or the characters of futures market. Advantages, pros and cons of futures market. All right. Number one, you don't own the crypto. You don't own the crypto. Come on, come on, come on, come on. What's happening? You don't own the crypto in futures. Are we together? No ownership to the crypto. Are you kidding me? All right. No ownership. So you are not going to be given crypto because you are trading the price. You are trading the price of the asset. Number two, futures has no leverage. I mean, is highly risky. Highly risky. Only trade with money you can afford to lose. Can I repeat that? Only trade with money you can afford to lose. Why? Because in the futures market, if the trade goes against you, you get what we call liquidated. We are going to understand that as well in depth. Only trade with money you can afford to lose. All right? High return, highly profitable. Highly profitable. Highly profitable. Highly profitable. Highly risky because of liquidation. Highly profitable because of leverage. Because of leverage, you can make money on both market movement. Make money in both directions. You can profit in both directions, regardless. In both directions, market direction. Unless unlike the spot market, where we only profit one way when the market is going up. So you buy low and you sell high. In the futures market, you can profit even when the prices of the market, the coin is going down. Now, this is what makes futures, this is what has made me love futures. How many of us here, you have been trading in the spot market and you noticed that most of the time, if not 90% of the time, coins will go down before they go up? How many of us noticed that? That most of the time, the price of the coin will go down after you enter the trade. Also, how many of us have noticed that when the prices of these coins, the fact that they are fluctuating, they move up and down, move up and down. How many of us have noticed that the coin can take long down than it can take long up? How many of us have noticed that? That you can enter trade and it stay down here for weeks, but when it rises up, it won't stay here for days. What this means, it means the opportunities of you profiting when it is going up as a spot trader are fewer compared to someone who is maximizing profit in both directions. When it goes up and when it goes down. Am I speaking to someone here? I don't know if someone is getting what I'm saying. Remember, I'm trying to give you a proper, different understanding of these two markets so that you make a proper decision as a trader to maximize profit. We said you don't own the crypto. The market is highly profitable as it is highly risky. It is highly profitable because there is leverage. Now, I'm going to break leverage in the next T. This is going to be our next T. So there is leverage here. What is leverage in futures? In futures market, it is the only place where someone who has $10 altogether, $10 can trade like someone with $100 because of leverage. It is the only place, it's the only market whereby if you are having capital of $100, you can trade as if you are having capital of $1,000. You are having $50, but you trade as if you have capital 500. You are having 1,000, but you trade as if you have a capital of 5,000. Give me an understanding. So this is what leverage does. Leverage is more like the exchanger borrowing you money to magnify your buying power or your purchasing power in the market. On a contract, on an agreement. Am I being clear? Do we have some people who have taken loans in banks? How many of us have taken a loan in a bank? You put there a car, they give you the money you need. You put there a house, they give you the money you need. You put there a collateral, and they fund your project. How many of us notice that majority of the society, we fear to take loans from the banks? Because the risk is failure to pay the loan, this asset goes, the collateral goes. Are you getting what I'm saying? I don't know if someone is getting what I'm saying. How many of us notice that we fear to take loans from banks, majority of the society? Reason, because you are scared that if I fail to pay the loan, the collateral is going to be taken. Now, in the futures, the exchanger gives you more power. It magnifies, you are the one to decide. It magnifies your buying power in the market by giving you an opportunity to leverage on the little you have. Leverage on an agreement. What is the agreement? That's why it's called contract. It's contract trading. The agreement is if the market goes, if the trade goes in your favor, you are going to make profit of the amount of money you are using to leverage. So for example, you are trading with $100, right? And with this 100, this is the actual capital you have. This is the actual capital we have. They call it margin. The technical term is margin. You can call it a collateral. All right? Now you apply leverage on your $100. How? You can leverage from 1%, from one time up to what time? I think it's like 150. You multiply this money. Altogether, you multiply this money. You can do times 10. Times 10. So how much is your buying power in the market? Times 10 from $100. It means now your capital has shifted from $100 to $1,000. Your buying power has been magnified. So in the market, you will be trading like someone with $1,000. You'll be trading like someone with $1,000. But here's the thing. If the market goes your way, remember we are trading the price of the asset, the coin. If the price goes in your favor, you make profit from $1,000. Yet you have $100. But if the price goes against you, if the trade goes against you, you stand chances to get liquidified. So the exchange will collect the collateral, which is the $100. The exchange will collect the collateral, which is $100. But I should also mention here that there is the reason why V6 has decided to introduce this strategy now is because with proper understanding and keeping the principles, you are able to hedge yourself against the liquidification or getting liquidated out of the market. Can you give me a 1 if at least you've understood something so far? I am taking this very, very slowly. I'm taking this very, very slow. I think we have a basic understanding now. So I think now you have the difference of these two markets. So what is my advice? What is not financial advice? This is what I would advise. This is what I would advise. If you want to give a try futures market, get 10 or 20% of your total capital of crypto trading. If your trading capital on Binance or in the exchange is $100, don't bring all your $100 in the futures account. Get 10 to 20%. If your capital is $1,000, do the same. Just get 20% maximum. And that is what is going to be your futures capital. Money that won't leave you, don't keep you awake the whole night. One thing for sure I'll tell you is here you can make money. You can make money. Now, let me also add something on this. The leverage you get on your capital, the leverage you get on your capital is going to be applied on all. It will be applied on your take profit. So not just the buying power. It will apply on your loss. It will apply on your margin calls in Loyo2 Now. It will apply on your first buying amount, the leverage. So here is an example of what I'm explaining. You have $100. Your margin, right? Remember I said the technical term of the base amount, the money you are using, your original capital. The technical term is the margin. So if your margin is, let's say, $50, you are going to continue. If you are using Loyo2, which is the one who I'm here to talk about, right? We are all here, Loyo2 traders. If we are trading with Loyo2, our strategy will remain the same. What do I mean will remain the same? We have our first buying amount. Altogether, we have our margin call limit. We shall also have our margin call drops. We shall have to give our robot our margin, our multiple buying ratios. We shall do the callbacks. We shall do the callbacks. The buying callback, the take profit callback, we shall do those callbacks. But here is the thing. If your first buying amount of $50, which is your actual amount, is $5, is $5, and you are using leverage of 10 times, 10x, okay? If we are using leverage of 10x, please don't, Joseph, don't touch the screen. Can you see what we're doing now? I don't know what you have filled the hours. Guys, I think everything is clear on the screen. Now, Joseph has messed up our what? Our notes. Seriously. I think everything is clear, guys. Hmm? I think everything is what? Is clear. All right, I think now it is very clear. Now, I was explaining something very critical here. I was explaining something very critical. Today is just basic knowledge, nothing complicated, nothing nothing technical. All right. So if you are using 10x as your leverage, meaning you are this your money, your capital after leverage is $500. Your capital after leverage is $500. Do you agree? Do you agree? I'm using $50 my base, and I'm doing leverage of $10. I mean 10x. My capital now is how much? My capital is in $500. My first buying amount will be how much? 50. So if I have done 4 margin calls, all right? If I have done 4 margin calls, so this is number of margin call. If I want to do 4 margin call, and each of my margin call, I am putting in for $5. $5. And I'm using 10x, leverage of 10x. It means the robot will be entering $50, $50, $50. Can you give me, am I talking to people here, guys? Hello? Are you understanding? Are you copying, or you are being copied? This is going to happen when the market go up as well. Now that is buying. What about selling, coach? So the price has moved in your favor. The price has moved in your favor. If the price moves up with 0.5, 0.5 of, let's say, $5, you've entered the position, the first position, first buying amount. This is now a question. First buying amount, $5, right? $5 of your actual capital, which is $50 after leverage. If the price moves up with 0.5, can someone tell me how much percentage would that be? Have you understood my question? If the price move up with 0.5 here, just here, if it is 0.5, this distance, this is the plus profit of 0.5. In futures, it is going to be 5%. 5%. What about if the profit moves up with 1%? With 1%. Just 1%. Just 1%. How much will be your profit? The percentage is going to be 10. You're already in 10% profit. But here is the logic. This is going to be 10% of. Now, this is from experience. And those of you have already traded. I'm not going to bring in margin calls now, for now. I will confuse you. Let me explain it as if there are no margin calls for now. Okay? So you have entered the coin with leverage. Your margin amount is $50. And now you are trading with $500 as the leveraged amount. You entered, the whole man has gone in the market. The price moves up. If the price moves up, all together now, with 0.5, that is going to be 5% of $50. You have magnified your profit, your percentage, your potential profit in the market. If it goes up with 10%, and it moves very fast, how many of us, Collins and uh, my brother who at 30, they have started trading in futures? Is what I'm training you what is happening to you? Is it true that it is easy to achieve 1% profit, which is 10%? 10% faster. And this is happening both directions. It can happen whether it's up or it's down. Because your purchasing power has been increased. It has been magnified. Your purchasing power has been magnified. Guys, can we proceed now? So I'm going to give a simple assignment. Simple assignment. As we close our call today. Now, to those of you who want to dive into this, futures is good. It has its own amazing benefit, like I've explained to you. You can easily make a lot of money with your small capital and grow fast. Just be ready to navigate through with me. I'm going to give a few questions today. I'm going to ask two people, three people, just come here and explain to us in their own understanding. The difference between futures and the spot. All right? You can unmute your microphone and just basically give your own understanding from what I've explained of what futures, the difference between futures and the spot. Based on what I've explained, can you give me simple explanation? Just unmute your microphone. Or if you have any questions, you can still ask about what I've just explained. Are we together? All right. Lack of question is usually shows that people. So let me ask Collins. Let me ask someone here. I'm going to pick randomly. Someone come and explain to us what is futures, the difference between futures and spot. Alex Kalobe. Alex Kalobe, you can unmute your microphone and give a simple explanation of what the difference between futures and spot.
Good evening, everyone.
Yes, good evening, Alex.
Me have learned and acknowledge that in the difference, like in futures, we make high profit. Also in futures, it is risky and you can lose money. What you cannot lose money, even though the coin goes down, but still you own it. So you unless when you decide to sell it manual, but you own it, and anytime it comes back, you make your money. You make profits. But in futures, when you are not keen and you don't follow the principles, you can easily lose your money. But you can make more profits in futures when you follow the principles. So I've acknowledged that we just need to be keen and follow the principles.
Yes.
While trading futures.
Yes. All right. Let me give another. Thank you so much, Alex, for that.
You're welcome.
Let me now give a chance to Collins, Atati.
Yes, coach.
Yes, please. Go ahead and
good evening,
give
everyone.
your own understanding. Good evening.
Yeah. In my own understanding, as we begin with our sport, in sport, you are rest assured of the asset, you own it. The biggest worry is the abnormal loss. So even if the abnormal loss, but you are sure anytime, even if after how long it will go up and you sell off, you still own.
Okay.
And decide to sell the floating loss, risky market, but you need to use the principles that can help you to go through. Make sure you follow the right principles, just like as the V6 said, have the percentage you use, make use of the margin calls, then the leverage, make sure you don't put too high leverage. Somebody may think about the 20x, yet you can easily use the 5 or 2 or 10, maybe maximum 10. So it is highly profitable with the small profit, small capital and bigger profit. Somebody can even a day make 100% of his profit, of his capital, according to the market, which is not in the spot market, where we wait for our 3% for the trade. So basically, that is what I talk about the futures.
Yes.
That is what I can talk about in differences.
All right. Thanks so much. That is Collins Atate, very aggressive in learning, great coach coming up. Now let me hear from one more person from Malawi. Flanka. Yes, Flanka. Frank, the microphone is with you. Frank, the microphone is with you. All right, Frank has requested the microphone. I'm not sure what's the challenge.
I think I'm on now.
Yeah, you are on now.
Okay, thank you. Thank you, coach, for the training, for the teaching about the difference between the futures and trading. Surely I've learned something. The difference between sports and future. One thing I've learned is that in spot market, when you buy the coin, you can own the coin. But then in the future market, when you're trading in the futures, we don't own the coin, but we trade the price. Yeah. And another thing is that in the futures, we don't own the crypto, but on the other hand, it is highly profitable. It's highly profitable. At the same time, it is also highly risky compared to the spot market. And another difference is that you said in futures market, we can also profit in both directions. That is when the market is going up and also when it is going down. But with the spot market, when you profit in one direction, that is you buy when the prices are low, then sell when they're high.
Wow.
So with that introduction, at least I've gotten somewhere. I've started.
Wow. Wow.
Thank you so
I think
much.
now we are getting to one page, all of us. If we understand this basis and understand the difference of these two markets and a few terminologies that are commonly used that have been able to tackle today, we talked about margin, we talked about leverage, all right? If you hear the term perpetual means basically contracts, okay? There are two types of futures. There are perpetual futures and there are what we call the delivery futures. There's the USDT perpetual future, which is the contract based, and then there is the USDT delivery futures. This one, now the difference between these two are the futures, the perpetual futures and the delivery futures is that the perpetual one has this contract has no expiry date. It doesn't expire. What that means is you can stay in a trade, you can either long the trade or short the trade and be in it for as long as you want. But if you are in what we call the USDT delivery contract or futures contract, those ones, they have an expiry date. So those are some of the very, very common terminologies that you should get used to. Things like perpetual, things like price action. I'm going to talk more about risk management tomorrow. Things like contracts. Now you have at least this knowledge, the margin, leverage, when do we apply leverage, right? So in tomorrow's session, I will be able to even get into the practical side of it. So take it slowly. I'm not here to rush into getting you rich quickly overnight. Some of you don't know that Julius has been doing these classes for almost, there's the hedge mode. I'm going to get into these ones, hedge mode, when I'm now practical on the what? On setting up, so that we get familiar with those ones. The hedge mode, yeah, the asset mode. I will be able to explain the details. So those of you who just saw the link of this session, they have been going on for almost 2 weeks. almost 2 weeks. So don't rush into it. If you have understood, if you are fast learners, you've understood what you are doing, that's okay. That's why I shared you the links. And even other sessions, the pre-recorded one. And unless you have gone back and watched those sessions, then you can do what? You can, if you don't understand something, take it slowly. Is that clear, guys? Can you give me a yes if that's clear? Because liquidation is not to scare you, it's real. And we are going to talk about risk management, on how you go around it without fearing it. Okay, so I'm going to end our call with a very quick summary of the difference between the futures and the spot. The futures and the spot. All together. Guys, futures, the difference of spot and futures is like a farming in both seasons. If you are a future trader, it's like a farming in both seasons, both rainy season and the dry season. So you don't wait for rainy season for you to make some, to farm. When the market is going down, you are happy. When the market is going up, you are happy. That is a futures trader. Is that clear? Is that very clear? So I'm going to share with you, a few simple rules that you can use as you navigate this journey. And I'm going to be breaking down these rules in our sessions as we continue learning. I'll be sharing a lot of more insights. We are going to look at how to determine the direction of the market, because futures market is all about direction of the market. If you are able to tell the market trend, and if you are able to position yourself at the right time, you are able to profit. You are able to profit. And that is exactly what we are going to be exploring. We are going to take it one step at a time. And I believe at the end of the day, I don't want to just excite you to make a few dollars today and tomorrow you are not profiting. No, 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 no. I want us to be real profitable traders in the futures market. I don't want to just give you a strategy. I also want you to become a pro, whereby you can do a lot of things even without me. How many of us would love such? How many of us would love such? So for those of us who are trading already, ensure that these rules are observed. Rule number one, don't trade what you don't understand. Don't trade what you don't understand. I'm going to show you evaluating the trade before you get into it, how to position, getting the market trend, and now you are able to maximize profit. So we only follow the trend, not guess the trend. Don't guess the trend. Follow the trend. Don't go against the trend. Rule number two, these are things you should follow when trading in the futures. Take this screenshot, keep it somewhere. Rule number three, we use stop losses or margin calls, or sell manually. I'm going to explain this. We lower the leverage to protect our capital. Don't use 20 times, 20x, 30x. Keep it short, keep it simple. We avoid fear and greed. Profit is profit. We don't need to chase it. Altogether. The other thing, what you don't need to do, we don't trade during big news and high volatility. I'm going to be explaining these rules. I wanted to share this in advance and share it to you on time so that you can be able to be guided. Some of the rules to check before you make movements. And I believe you will be able to profit. Is that clear, friends? Why don't we call it a night? Why don't we call it a night? Why don't we call it a night? So tomorrow, don't miss tomorrow. I'm going to talk a lot about trends. And those of you who have dedicated themselves to learn this massively, in the morning, join in the class of V6 Julius at exactly 7:30. I'm not going to do my own session at 8 a.m. I want you people to understand, gather as much information as you can, take notes, see, and every step you are taking, collect lessons. If you make a mistake, write it down, take screenshots of what you are doing so that you can document your experience and journal it down. You will be able to learn from your mistakes and improve your trades and get better in your journey. That's how you're going to become profitable. Don't get greedy. Don't get too excited. You are going to make this happen massively. So thank you so very much. We meet up tomorrow in the morning, 7:30 in the morning, Uganda time. We get on the V6's call so that we can learn more, grow more, and get better. Thank you so much. God bless you all and have a lovely night. If there are no more questions, thank you.